Hi, are you ready to take your financial statement analysis skills to the next level? Whether you're preparing for professional accounting exams like ICANN and other top-notch ones, or applying these insights to real-world scenarios in the workplace, this video is your ultimate guide. In this session, we are diving into the detailed analysis of financial statements. The critical steps where the real stories of a business come to life. We'll break down each of the three key financial statements: income statement, statement of financial position, and statement of cash flow, to uncover hidden trends, assess financial stability, and evaluate cash flow dynamics. This isn't just about passing exams. It's about mastering a skill set that empowers you to make data-driven decisions in your career. Let's get into it as I share my screen, as is our custom, and let's look graphically into this topic very, very vividly. I've got mini as usual. Let's go. Detailed analysis of financial statement. The next step, after we've looked at the initial analysis, is to carry out a detailed analysis. In the last video, we talked extensively on the initial analysis, questions to ask. So the next step you take is the detailed analysis, and this is to conduct a detailed analytical review of the financial statements. So you are expanding substantively your initial analysis to see, to dig deeper or dive deeper into the financial statements. This involves examining and explaining the information provided in each of the three key documents, together with the detailed notes to the accounts, and breaking that analysis down into individual components. This is very critical. So the income statement, including the statement of changes in equity, you ask questions like, how is the business performing? What are the key elements of its result? So from the income statement, you should know how profitable the business is. Is it making high or significant profit? Is it making marginal profit? Is it making losses? These are key elements of the results of the business. So we're looking at revenue first, the trend in total revenue. What are the revenue streams? Which revenue centers are doing better than the other? What components of revenue, what areas of the business are thriving, and what areas of the business are not doing well? What are the sales mix related costs? What is the gross profit after you've accounted for cost of sales, cost of goods sold? What are the operating profits after you've deducted distribution and admin? Any overall profits or losses, surplus or deficits? So this income statement analysis is developed further. And we develop it further by carrying out this detailed analysis. So looking at the statement of financial position, is the business financially stable? Is the financial position, by analysis of the statement of financial position, looking at the components of assets, liabilities, and capital, is the company stable? So let's look at the total assets comprising of the non-current and the current, the net assets, that is the total asset less total liabilities, the net current assets, the gearing, the leverage between debt and equity, culminating in the capital structure of the company, looking at that from the capital side of the financial state of the SFP. What is the quality of the assets, the nature of the liabilities, and the statement of financial position structure. So these are key details that you need to deeply dive into. Consider the main components, the current assets for day-to-day working of the business, running of the business, the current liabilities, settlement of day-to-day obligations, the non-current assets, investment in assets and long-term running tools of the company. What are the equity, the shareholders' funds, and non-current liability, the debt the company owes on a long term. So these main components should be analyzed in detail. This is very important in conducting your financial statement analysis. An analyst, a student, aspiring chartered accountant, a chartered accountant in practice or in business is particularly concerned about any shortfall between the amount invested in the non-current assets, which is number 3, and the long-term funding of those assets, number 4. Very, very key, because this means, and it's dangerous, that non-currents are being funded by short-term finance. It's dangerous. Very, very dangerous. So short-term finances that are supposed to be used as working capital, if it's funded or it's funding non-current assets, fixed assets, which are capital in nature, this is disastrous for the business. So this analysis should be taken very, very critically. The statement of cash flows, you ask vital questions in your detailed analysis as, is the business using or generating cash? And why? What is the reason is using this cash? What is the relationship between operating results and the cash generation usage? So it's cash generation and utilization. What is the relationship? Very important question. Always remember the interconnectivity between the 3 statements and the effects of the often subjective key bridges, the bridges between them, particularly between the income statement and the statement of financial position. These bridges include items such as closing inventory at the end of the financial year, including work in progress where it's a manufacturing company that has raw materials metamorphosed into work in progress and finished goods. So the work in progress, you look at how raw materials transform to finished goods, and these bridges are important that culminates in inventory at the beginning and at the end of the year. Look at depreciation for tangible assets and amortization for intangible assets. Impairment, that is the reduction in cash generation in cash generating units of these assets. Deferred income, have revenue being earned. Revenue could be declared where services or goods have not been provided. So have this income be earned by provision of those services and fulfillment of obligations passed to the final consumer. We also look at provisions such as impairments of accounts receivable or doubtful debts based on IFRS 9, looking at provisions, expected credit losses. These detailed analysis are key. All these bridges affect reported profit, but candidates should always consider the impact of changes in these bridges and evaluate the related assets shown in the statement of financial position to identify materiality. This is very important. Materiality concept in the sense that how material are these figures and how can they influence stakeholders' decision making, senior management, investors. So materiality in the amounts in particular areas of the SFP, the SCI, and the statement of cash flow are key. So where amounts are running to the tunes of hundreds of thousands, millions of naira, here due care should be taken to perform detailed analysis, testing, substantive, and compliance to make sure there are no gray areas or issues or tables unturned. Very, very critical. So in your analysis of these 3 key documents, you need to break your analysis down into individual components, break it into chunks and comprehensive components. The specific questions that you need to ask and be able to answer are detailed in Module 4. So stay tuned. We'll be looking at that in subsequent videos. All right. Congratulations. You just unlocked the secret of conducting a thorough and insightful financial statement analysis. By mastering these techniques, you are equipped to identify financial strengths and weaknesses, spot red flags, and deliver actionable insights for business success. If you find this video helpful, don't forget to like, share, and please drop your comment and thoughts in the comment section. Let me know what resonated most with you, what topics you would like me to cover next. Remember, your ability to analyze financial statements in detail isn't just a technical skill, it's a strategic advantage. Use it wisely to excel in exams and make impactful decisions in the professional world. Until next time, stay analytical, stay curious, and keep trying. Until next time, bye for now.